Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We sincerely hope that all of you are staying safe and healthy at this time. Today, we are going to continue to keep pace with policy, and we are going to talk today about tax planning in a period of increasing rates, which is always very interesting. So I want to welcome Kelly Hardy, and she's with our ABC group, and Nick Romanelli with our manufacturing and distribution group. Hi, friends.
Hi, Leslie.
Before we get started, we are going to review a few housekeeping items. As you know, we have activated the live Q&A so that we can interact with you during our show. So if you're registered, you can add questions and you can even like those to move those up in priority so that we can better address them. I'd also like to urge you to subscribe to our YouTube channel and hit that like button so that those live streams are easy to find. I also want to make you aware of a couple upcoming webinars that we have. You may not know it, but October is actually Cybersecurity Awareness Month. So we have all sorts of webinars that are geared towards that, and they're going to cover a whole host of topics, including how to be compliant, how to protect your retirement plans, higher education topics, and then even financial institution incident management. So be sure to check those out. On November 2nd, we're going to tackle the future of the workforce, which I know is hot on almost every organization's mind because nobody seems to be able to find enough workforce right now. And then you definitely want to pencil in on November 17th, our financial health webinar series on individuals, which is going to talk about year-end tax planning, which I think is going to be super exciting this year, just given all of the policy changes that we have going on. So that's a lot. It's going to be a very exciting rush to the last end of the quarter here. So visit our website to register for those, and then always contact your CLA relationship because we absolutely want to connect and engage with you. But with that, let's get down to business. We have a lot to cover today. We've got the budget, reconciliation, tax proposals, and we're going to start to unpack those a little bit. And I think as we get into that, it's really important to overlay that as we're seeing these come out and we've got some key individual tax rates out there being proposed, it's still really early in the legislative process. So while we're going to talk about and outline these proposals and what you can start to think about and do, know that they are certainly going to morph and change a lot. So keep that in the backdrop here. And so, Nick, I want to start with you. And I think before we dive into how do we start to plan in this time of uncertainty, why don't you just start with what are some of the overview of the key individual rate provisions that are in the proposal?
Yeah, thanks, Leslie. Individuals currently have a top tax rate of 37%. In the proposal, that top rate would increase to 39.6%, and that would apply to taxpayers on a married filing joint basis with taxable income over $450,000 and single individuals over $400,000. The date of this change would be effective January 1st, 2022, and that distinction is important because the other change would be moving capital gain rates from a current top rate of 20% to a top rate of 25%. And the effective date on this change would be September 13th, 2021. Now, there are some exceptions if you have a gain arising from a transaction that had a written contract entered into before September 13th, 2021. But if you didn't, you would be subject to that 25% max capital gain rate.
Yeah, so I think it's really important here that we got to understand that dates are going to matter as we move through a lot of this. Certainly, you've highlighted here a couple key changes with rates going up on both the ordinary rates and then the capital gains rates. Those are stated rates. I think it's also important that you highlight that sometimes there's also rate increases that aren't necessarily, stated rate increases, but they tend to sneak in other ways because calculations change, certain deductions get dialed back, or they're not necessarily tied to an ordinary rate or a capital gains rate, but they're just little surtaxes or things that sneak in. So why don't you talk about some of the rate increases that kind of creep in that are less evident?
Yeah, there's a few big ones to think about. The first one would be some limitations that could potentially apply on your 20% deduction under Section 199A. That deduction under the proposal will be limited for taxpayers with more than $500,000 of income on a joint return and $400,000 on a single return. The other change would be the 3.8% net investment income tax would apply to ordinary income from a trade or business regardless of material participation. Currently, if you're a material participant in an S Corp, that 3.8% doesn't apply to the residual income from the S Corp. This is saying that 3.8% would apply regardless if your income is over $500,000 on a married filing joint return or $400,000 on a single return. There's also a 3% surcharge that they're proposing for taxpayers with modified adjusted gross income over $5 million.
Yeah, so I think that's a really good overview. I mean, it's always been sometimes advantageous if you've been a material participant in an S Corp compared to a partnership. We'll get in later to choice of entity as a talking point here, but I think that just frames yet another potential rate increase that you could see on top of some of the changes in the ordinary and capital gains rates. So that's a really good synopsis of the individual tax rate changes. Kelly, how about you highlight some of the proposed corporate tax rate changes?
Sure, Leslie. Currently, we're in a flat 21% environment, which is historically low. The proposal would replace the flat corporate rate structure and go back to a graduated rate. So anything below $400,000 of income would be taxed at 18%. Up to $5 million beyond the 400, you'd be taxed at 21%, and then anything over $5 million is taxed at 26.5%.
Yeah, so corporate rates are potentially going up, but it could really depend on where you're at from an income standpoint, which I think is interesting. So that's a helpful overview. And so, Kelly, normally our tax planning has focused on, I would say, deferral of income. And this year might be a year that we're actually looking at accelerating income, but there can be pros and cons of that. So when you think about that, how does that sit with you?
It feels strange to want to accelerate income. On the downside, you're cash out of pocket, you're losing some time value of money. And if nothing passes, you've paid ahead. But on the upside, you're hedging your bets. We know what the rates are. We know they're historically low, and you know what you're going to get and avoid the risk of a higher rate.
Yeah, those are some really good perspectives. And I know everything is still in proposal. So some might sit there and go, well, why does it make sense? We're sitting here in October, everything's still in proposal, to start planning early on some of these techniques to accelerate income and defer deductions. And Nick, I would love your feedback on that.
Yeah, you know what? You're going to need some time to start planning for these things, and you're going to need to look at your specific situation to see what impact the proposal might have on you. For example, you might have higher income in 2021 as opposed to 2022. And so maybe the rate increases that they're talking about aren't going to impact your return in 2022, and your rate might be overall lower in 22 rather than 21. And in that scenario, you wouldn't want to pull income into 2021. You also have to consider the cash flow impact. So accelerating income into 2021 means there's going to be more tax due in 2021. And so if you have to borrow on a line and maybe pay 3% to pay the interest down or to pay the tax down, maybe it doesn't make sense to accelerate that tax if you don't have the cash flow. So there's a lot of considerations. I think you really need to review your specific situation to figure out how to react and plan for it.
Yeah, I think that's really good thoughts. We never want a tax plan in a vacuum, and we never want to take a one-size-fits-all approach, because it never is a one-size-fits-all approach. So I think that's important to understand where you are in the current year, and then you've got to understand what moves you might want or you need to make. So, Kelly, as you think about that, why else would you want to start now as you think through those thoughts?
Sure, and everything is in proposal stage at the moment. We're still all in flux. We don't know when we're going to get final legislation. The last two major tax reforms have come in December, right at the end of the year. But if we get to December, you're out of runway. So we need to start planning and evaluating now. Have things ready to go, ready to sign in case you need to make a quick change. Some strategies like non-automatic accounting method changes, they have to be filed prior to the end of the year, and they take time to get done. Certain strategies also might need to take proactive measures within your business to execute. So time is of the essence. We need to get moving now to be ready in case something does happen when it happens.
Yeah, I think those are good points, is that some of these could take a couple months to actually pull off, where you may have to take some decisive actions in your business before the end of the year, in which case you don't want that ship to sail. So I think now is a good time to maybe unpack what are a couple of those techniques or those decisive actions as we get into the fourth quarter that keep our tax planning flexible and accelerate income. And there's a couple different methods of accounting. We've got the cash method and we've got the accrual method. Kelly, I'd love you to start with cash method techniques if you wouldn't mind.
Cash method is more fun. So first of all, you can look at accelerating collections. Maybe you offer a discount to get money in the door faster. Instead of billing at the end of the month, maybe the bills go out on the 10th of December or the 15th, and then some calls are made to get collections in before the end of the year. If you're a farmer, this is a perfect time to put your grain on deferred payment contract. Wait for the check, but you have the option of playing with either side of the year as to where you claim the income. Expenses, you want to defer those now. So you stop writing checks in December and take some time to do some pickup on the income side. Accrual method is harder, but there's some options. You can certainly look at deferring you can defer prepaying certain expenses before the end of the year so that you don't have to take that deduction.
Yeah, it's so backwards, isn't it? Normally with prepays, we're thinking about how can we pay those early to get that deduction, but this year we're saying, maybe I'm going to pause a little bit. So I think those are great considerations for cash method taxpayers. And, you did say those are fun. Sometimes we've got a little bit more flexibility, but, Nick, certainly we don't want to leave our accrual method friends on the sidelines of this. So what do you think they could do with that?
Yeah, we've got a few strategies that accrual-based taxpayers can use as well. One of them is around compensation. So normally, as an accrual basis taxpayer, in order to deduct compensation, all events have to occur to fix the liability, and the compensation has to be paid within 2.5 months of year end. And so in a normal year, maybe you pay the bonuses on March 1st, it would be within that 2.5 month period, and you'd be able to take the deduction in the year that the bonuses were accrued. Maybe this year the strategy is hold off on paying the bonuses until after that March 15th date, maybe March 20th, so that it falls outside of that 2.5 month period, and the deduction would get pushed to the 2022 tax return at potentially a higher rate. You've also got some strategies around depreciation and capitalization of certain expenses. Normally, when you're looking at year end, you're trying to accelerate purchases, and in the current environment, having 100% bonus depreciation, that also means you're writing off those purchases when they're placed in service. Maybe this year we don't rush to place something in service, or we hold off on buying new equipment and place it in service in 2022 in order to get that deduction at a higher rate. You also might want to look at opting out of bonus depreciation. If rates are going to be higher in the future, instead of taking 100% bonus on your 2021 return, maybe you elect out and you use a different method that would push at least some of that deduction into the future at a higher rate. There's also, most companies, when you're doing repairs, you're typically expensing those because you want the deduction today. There is a special election for taxpayers to capitalize certain repair costs as opposed to deducting them. And kind of the same concept on the capitalization of equipment, you're just trying to push that deduction back into 2022 or later at a higher rate, as opposed to just expensing them in the year that you acquire them. You also have to kind of look at, when you capitalize those assets, what's your depreciable life? So if you capitalize an asset and it ends up being part of your building, that's going to be a 39-year depreciation period. That's a pretty long time. And at that point in time, the acceleration of the deduction might outweigh the change in the tax rate. So again, as we talked about before, every client has a unique situation, and you really need to dive into everyone's specific situation to understand their option.
Yeah, those are some great strategies, and certainly you could do a couple of those and really accumulate some meaningful savings, especially if you've got a 10 to 15% rate differential, potentially with all of the 3.8% and a potential surtax, scaling back of the 199 Cap A. So that could be some really meaningful dollars. Kelly, are there any other elections or even accounting methods that you might want to consider?
Yeah, the first thing we need to point out, again, like Nick mentioned, the effective date of the capital gains rate right now, as it's proposed, is September 13th. So if you had a sale in the current year prior to September 13th, you're good. You're covered by the old rates. But if you had intentions of, using the installment method and electing to tax that gain as payments are made, you may want to elect out and make sure you get it taxed at the lower rates. Sales after the 13th of September, as proposed, are going to be taxed at the higher capital gains rates. Other accounting methods to consider, think about capitalizing and amortizing R&D costs instead of expensing them. Look at your unit cap method if you're a manufacturer. Maybe we could add to that balance this year instead of always trying to want to subtract from it. And then look at deferred revenue. Normally you have the ability to defer revenue up to 1 year after it's collected, if it's basically a prepaid sale under Section 451C. There's an option to elect to pay the tax on the revenue in the year the cash was received instead, and that might be a good strategy. But with everything, you don't want to make decisions just based on taxes. So think these through as long-term strategies and what all the other implications are too while you're doing your year-end planning.
Yeah, I mean, I think what you said is so important. Certainly tax is important. And I think not only the tax implications, other implications are important, but even changing a method, we're going to be locked into that for a period of time. So even though you get a potential tax savings this year, you've got to think, okay, do I want to be locked into this for a period of time as well, and think through that. So I think that those are really good thoughts, Kelly. So another thing that we did mention here is we've compared the individual rates, and we also talked about the C corporation rates. And so anytime we've got tax reform and we've got rate spreads, we get the question a lot of, does it make sense to become a C corporation or choice of entity? And we got it a lot with the Tax Cuts and Jobs Act. I think that that's coming up again now as we get these proposals out. And so, Nick, what do you think about the choice of entity topic?
Yeah, I think it's definitely worth modeling. And you're right, Leslie. We did see a lot of this modeling back with the TCJA. We're going to see a lot here, and hopefully we can get a little break and won't have any tax changes for a little bit after this round. But yeah, there's definitely a consideration to be made on entity type. You've got a lot of different factors. So again, it's looking at your specific situation, whether or not you're going to be pulling dividends out, how long you've held the stock, how are you going to exit the business, are you profitable, what's the ownership look like? So there's a lot of different factors there. Some things to look at and to consider. So currently, as Kelly mentioned, we're in that flat 21% rate for C Corps. The proposal is introducing brackets again. That was kind of how it was historically. And so there could be some organizations that taxable income isn't into those upper brackets. They actually may have a lower tax rate or sit at that same 21%. So there's a lot of different decisions to take into account here. You also have to take into account, Leslie mentioned it on the accounting method changes. Once you convert to a C Corp, you might not. Yeah, sorry about that. So what I was saying there is, as Leslie mentioned on the accounting method changes, if you make certain changes, you might not be able to undo those changes for a 5-year period. So while we have changes now, there could be future rate increases within that 5-year period that you would have to consider, and maybe you want to make sure that you don't get locked into a certain entity type without understanding the risk.
No, I think that's a good point. It's easy to get into a C corporation structure and can be much harder to get out of that. And so I say sometimes the C corporation's like a roach motel. It's easy to get into and hard to get out of it. Just proceed with caution there. So we have some questions that we want to take into the consideration from the audience here. Some of them are procedural, some of them we may not have the answers to, and so we'll play along and just see what you guys think of this. I know you guys are both sitting on the policy team alongside our national tax team. And so the first one is, if the signing of the new law is completed in 2022, could it be retro to 2021? And I would love somebody's thoughts on that.
Yeah, I don't know that the rate on ordinary tax is going to go retroactive back to 1/1. I do think part of the reason why they put that September 13th date in there on the capital gains piece is they're trying to control a massive sell-off in the fourth quarter. If everyone knew that rates were going to go up prospectively, they might make a different decision and try and exit some of their investments to make sure they trap that capital gain at a lower rate. So I think that's why they put that September 13th deadline in there, date change in there. Kelly, not sure if you have any other thoughts.
No, same thoughts, Nick. And in some ways, I think, why not have a massive sell-off and collect all that tax? And I think that'd be great. But you're right. That's why it's in there, so that people don't take action that, they don't want to have happen.
Yep.
Yeah, so it's interesting, right? There's a lot of different proposed effective dates that are in there. Certainly, we've got some proposed effective dates too related to certain intentionally defective grantor trusts and the estate tax rules that talk about the proposed effective date, I believe, being the date of enactment. And so those could just be date of enactment. We've got some proposed effective dates right now as of 1/1/22, and then certainly the capital gains rates where you're right, it seems they've drawn a line in the sand basically to avoid a run on the stock market. So I think certainly these dates, like anything in those proposals, could move based on negotiations, but I guess we'll see what happens here. We have another question that's related to qualified dividends. And so the question here is, are there any planned rate increases for qualified dividends from the current maximum rate? And so the capital gains rate's gone up. What about qualified dividends?
Yeah, qualified dividends would fall in the same rate bucket as long-term capital gains, so that rate would increase. And I believe in the past, this change, when it went down, we had to bifurcate dividends between a specific date in the year before and after. So be a little more work on the brokerage statement this year to separate what goes where.
Yeah, and I think what could be interesting too is not only do you have a potential increase in the dividend rate itself stated, but certainly too, we've got the proposal related to the surtax over 5 million, and certainly that could also get hung up in that. So I think there's those unintended rate changes as well that we don't think about. We've got another one that I think is a fun debate right now related to the SALT deduction. And so the question is, how does the possible change in the SALT deduction affect decisions if I pay my property taxes this year or next? I think this is a fun topic as we get into Q4.
Yeah, so that was the historical strategy. So before, when you didn't have that cap, that $10,000 cap, again, to accelerate a deduction, you were making that property tax payment before year end. And I think there was one year where there was a very specific date, and you saw people lining up outside of the county collectors 2-3 blocks long to get the money paid in so they could take the deduction. I think this year you're really just kind of weighing different facts here. I don't know when that effective date's going to be. I don't know that they've made any more progress on whether that change in the SALT deduction is going to be implemented. So you still have a little bit of time, but if you can take the deduction and we don't have that cap, then you're really looking at your rate. Is your rate paying it early and taking the deduction in 21 higher or lower than the rate that you're going to have in 2022?
Yeah, so I think it's kind of one of those things too, where everything that we're doing is so counterintuitive to what we've been programmed to do. I think, Nick, to your point, we've always been programmed to say, yeah, let's pay the state piece early before 12/31. But this would be a year where I'd say, let's maybe defer that, because if they were to reinstate that, we'd want to possibly get that benefit later.
Yep.
So I think that's a good point. Okay, we have another question about capital gains. So does the capital gain rate include 12/31 assets as well as investment gains?
Yeah, it would include 12/31 assets, farmland, real estate, all that is taxes, capital gain, and would hit that rate change as well.
Yeah, so that's a real bummer for your farm clients, huh?
They're sad. I had one this morning that was sad.
Yeah. Well, any other parting thoughts that you guys have for our guests here?
Don't forget, I think it's just a good time to get all your ducks in a row and make sure you know where you're at before the end of the year and before something happens.
Yeah, I think you kind of have to plan for a few different scenarios here. Kelly mentioned you might need some time, a little runway to get things set up. So I think kind of having that discussion now and planning for the proposal or potential note changes, I think either way, you've got to have some conversation and have some planning before year end to make sure you can execute if we have to do something before a rate change.
I are great insights. This has been a really great session today. I think you guys have certainly highlighted we need to plan early and often. I know we're going to be hearing more as we keeping pace with policy all through fourth quarter this year. And I appreciate you guys joining us today. So thank you so much. Thank you as well to our audience. Thank you to the moderators who have been live in the chat answering questions. We will see you next week. But until then, everybody have a wonderful weekend and stay safe and healthy. Thank you so much.
Thanks, Leslie.
Thank you.